Hello and welcome. My name's Chris Can with Mining Journal, and with me I have Marimaca CEO Hayden Locke. Marimaca, of course, is in the process of finalising a DFS on its namesake copper project in Chile. And today we're going to talk to Hayden about the financing of the company and how they're going to put the pieces in place to actually start building. Welcome, Hayden.
Thanks, Chris.
Recently, there was a little bit of a reshuffle on the share register there with Azure coming in, Tembo Capital, a cornerstone PE investor there who've backed you for a long time, making an exit. What does that mean for the overall balance sheet and positioning Marimaca for that final push into financing for the project?
It's amazing for our balance sheet. It's very sad to see Tembo go because they're a fantastic capital provider and capital partner for a junior resources company, but equally very happy to have, timing is everything, as I think I've said, and Tembo are at the end of their fund life, and so logically were they going to commit to the next phase, which is building the project, and they probably could, but I think it would have taken a lot of shuffling internally, and so very happy that they were willing to transition their ownership to a new group who is very long term, exceptionally well financed, really understand the mining industry, and very supportive of our objective to become a copper producer. In terms of our balance sheet, I mean, it provides us with, in our view, enough money to get to financial close and FID, which ideally will be at the end of 2025. And it allows us to start really going aggressive and hiring the owners team to build, the execution team. We are really starting to go out and say, okay, what does this look like as we transition from where we are today to actually commencing construction and delivery?
I suppose the other thing about it is obviously you've intentionally built yourself a little bit of fat and margin around putting in place the other pieces that are required to get final financing in place. What are those pieces? What does the timeline look like? And how does that slot in with delivery of the DFS and that important period where you actually start to build the project?
Well, the big part is probably the debt financing portion, which it can start just before you finish the definitive feasibility study, but most of the work is done once you finish the DFS, and then you have the independent technical experts of your financing partners reviewing the technical work, forming a view on whether they think what you're presenting is believable and is a good business case for them to underwrite as a debt provider. So we've started that engagement. We're in the process of working through, okay, who do we want to partner with? Who will we talk to? The answer is everyone, because what I know is capital comes and goes, and sometimes it's there and sometimes it's not, and you've got to be flexible and ready to grab onto opportunities as they're there. So really the timing is, what it does allow us to do is, while we're doing that financing process, we can go straight into detailed design and engineering, and we can take the DFS, which is not the finished product. You would very, very rarely would you build a project based on a DFS. You then take it to the next level, which is detailed design, detailed engineering, and you're really tightening up on all of the inputs that go into the final capital cost estimate.
Okay. And with the debt financing, what kind of groups are you looking at? I mean, once upon a time, back in the day, it would be commercial banks and it would be some high street names that would be interested in financing a mining project. Those days are past. And there are other providers, thankfully, that are in the mining space. What kind of groups are you speaking to about debt provision?
So there are a select group of sort of project finance banks that are focused on mining, or at least have some capability in mining. The benefit we have is being in Chile, which is a tier 1 jurisdiction. From a financing and geopolitical risk perspective, there's more banks than you would find if you're in a more fruity jurisdiction. So we're certainly talking to several groups. There are some new players coming into that market, some banks that haven't realised that they're large-scale financiers in the mining space, and are wanting to leverage that and have enormous balance sheets. In the second phase, we're talking to I guess we call them non-traditional mining-focused lenders. So they're a core group that have been around for a while, but then there are quite a number of additional groups now that have capital and have the ability to finance. The benefit, again, that we have is, in terms of size, expected debt, we're not going to be much more than $300 million of debt, which is perfect bite size for a lot of these funds that have got several billion under management. Much bigger than that, they'd need to partner, they'd need to do a club. It just creates complication. we're also talk to all sorts of other capital providers. So, one of the benefits of the product that we will deliver is although it's not as good from a trading perspective as concentrate, as an example, low carbon intensity copper cathode is a tradable product that has a value to the big trading houses. And so there's the potential that we can do prepayment financing where we effectively do a debt deal, but we pay in the product. So we're examining all of those, and we'll do the work to work out what's best for our current shareholders.
Interesting you mentioned low carbon copper. We've seen groups, the ones that I'm most familiar with actually in the gold space, that have done sustainability linked debt packages. Marimaca, you've described previously as blessed in terms of its positioning as a low carbon copper producer because of its infrastructure and location. Does that mean that you've got access to either officially low interest debt options because they're a sustainability product, or just that people are more willing to lend and they've got lower hurdles to clear because of that low carbon nature of the project?
I don't think they've got lower. Well, maybe it's the phrasing of your question. I don't think there's a lower hurdle to clear, but I think the sustainability credentials that we have make it easier for groups, for us to get through the process of due diligence that these groups will have to go through. Certainly at a banking level, they've all signed up to various targets and their overall desire to invest in and lend to sustainable projects. And so the more sustainable we are, logically, the easier it's going to be. And we believe we will get a lower cost of capital if it carries demonstrably lower risk compared to our peers. On the flip side, there is also, at some point in the future, it's probably not going to happen while we're in the construction phase, unfortunately, but we do strongly believe that at some point in the future, there will be a premium that is paid for product that can be linked to being more sustainable as it becomes more and more important, especially as carbon taxes and things like that go up.
Okay. Previously, when we've spoken about the financing package, we've talked about what is mathematically the best possible structure that you could do from a shareholder perspective and a project build perspective, and what that looks like against some of the softer issues that you might need to consider when you're presenting Marimaca to the market and market perceptions. As we get to the pointy end of this decision, Hayden, how are those two different factors interacting, and where do you feel like you might end up in terms of a financing mix?
It's very important to consider the soft issues as you describe them. One example is project finance banks typically have quite low cost of capital, but tend to be very rigid and highly structured in terms of what you can do with your cash flow, how you can run your business, all of those sorts of things. And if you're in an industrial business where expansion is something that can create value for shareholders, flexibility needs to be considered. Flexibility of your financing structure and how your cash flows are sent back to debt financiers needs to be considered against the cost of that capital. And so, we're actively considering it all, and we'll have a look at it. We don't know yet what that outcome will mean, but it's certainly a consideration. It's a very important consideration. We're not just going to jump into the cheapest source of capital, because all of those things add up to a business that can make more value for potentially more value for shareholders if you consider it.
Okay. And in terms of the register and just your market presence, one of the concerns that investors would have is around liquidity if they're looking to get involved in Marimaca. What's management got up its sleeve for addressing that legitimate concern?
Yeah, it is a legitimate concern. It's probably the most difficult thing that we've had to deal with, or to try and deal with, and we haven't yet solved it. The alternatives that we have at our disposal are we either convince our major shareholders to sell down to the market, which is quite challenging because the market typically doesn't want to pay above the price that we're trading at. And we have a lot of information internally, and we can see that we're trading at a discount, probably because we're so illiquid. So that's one alternative, but I doubt that would happen because our shareholders are privy to the information we are, and they know that this project is worth significantly more than where we're trading today. So the way I'm seeing it now is, in an ideal world, we'll submit our permit application in the next 3 to 4 weeks, I'd hope, and then we will have a view on when we'll start construction and a view on when we'll need to raise capital. And at the time that we raise capital, we'll go out and we'll take in new money from our external investors. There's not very many new copper projects coming to market, and so we think there'll be a very good opportunity to bring in new money, and we'll start the process. And, having discussed with our major shareholders, they're very willing to look at doing block trades after we're financed and after we start to see, some sort of movement in the share price, and we're a little bit closer to the final post, which is producing first copper. And so I think it'll be something that we'll do gradually over time, but we're very focused on it. We've got a few things that we're cooking in the background, which should assist in that, but it's not going to be overnight. It's going to be a sort of 12 to 18 month process.
When we're having this conversation, Hayden, we're talking about how you would be structuring the finance, what your options are. We're making some assumptions that the finance will be there for you. That feels like a reasonably safe assumption given the quality of the project and the conversations you've been having. But how would you describe the financing landscape out there at the moment from what you're experiencing yourself and then also what you're hearing from peers? You're confident of raising the capital. Why is that? Is it about copper? And what are you seeing in the broader market?
Well, we have two fantastic, significant shareholders in Assor and Ataki now, who both have, and there's no guarantees, of course. Things can change in the next 12 to 18 months as we move towards the day that we put the shovel in the ground. But as we currently stand, both have significant amounts of capital to deploy, and copper is a key focus for them, and they're both very long-term investors. Neither of them have short-term funds that need to be, they can take a view and say, like me, we think copper is something that's going to be a really good investment for the next 5 to 10 years. And of the copper space, there's very few things that compare to Marimaca, other than its scale. There are other projects that are bigger, but not much that's as favourable in terms of risk-adjusted returns. So I think with those two groups, we have the cornerstone that provides me with the confidence that the equity is available. And then on the debt side, there's a lot of debt capital available. The market, it's not necessarily the project finance banks, although they still exist. But what I know is there are very few projects to be financed, very few projects where banks can have confidence that the equity will be there without a major partner. So I would expect there'll be a lot of interest. And we've already seen a lot of interest. I think when we go out and run our debt process, there will be a significant amount of interest. So I'd say, it's very positive that we're in Chile, which is considered, despite all of the things that have occurred in the last 2 or 3 years, still considered to be a very investable jurisdiction, still respects the rule of law. I think there's limited risk of a sudden overnight change in the general mining code that would cause debt investors to run for the hills. So I'd say I'm fairly confident. Obviously, what we need to do is deliver a really top-notch definitive feasibility study. We need to show that we've considered all of the risks. We need to build the owners team to show the banks and our debt and our equity partners that we have the capability in-house to manage our contractors and deliver. And we're starting that process now.
Hayden, that's all we've got time for. Thanks so much for joining us.
Thanks.